So today we are tackling something literally every single market participant has faced at some point. That sudden, gut-wrenching panic when you see one of your assets dropping. But we're going to look at some really fascinating source material that breaks down the precise mechanics of unrealized gains and losses, specifically in the cryptocurrency spot market. Let's find out what the data actually tells us about strategically managing these inevitable moments.
Okay, let's dive into this. Here is our highly logical path for today. First, unrealized gains and losses. Second, navigating unfavorable price movements. Third, purchasing additional margin. Fourth, shifting your entry price. And fifth, overall portfolio valuation.
All right, section 1, unrealized gains and losses. So I want you to think about this for a second. What actually happens when your crypto drops? I mean, we all absolutely know that feeling, right? You open your portfolio tracker, you see that giant red line, and suddenly you're, contemplating moving to the woods and living off the grid. But the source material we're looking at today pushes back hard against that emotional reaction. It really urges us to look at the actual underlying financial mechanics at play. The text defines unrealized P&L right here as the fluctuating financial mechanics of a digital asset's value in the spot market prior to closing a position. Now, the absolute most crucial phrase there, prior to closing. You see, an unrealized loss is just a dynamic variable. It is not a finalized defeat. Honestly, as long as you hold the asset, that number is simply reflecting the current market temperature, not some irreversible loss of your capital. Grasping this dynamic, fluctuating state is kind of the key to everything else we're going to talk about. Moving right along, section 2, navigating unfavorable price movements. And this brilliantly illustrates exactly where the tension lies in literally any trade. On one side, you've got your initial entry price, what you originally paid for the digital asset, right? And on the other side, you have the prevailing market value, what that exact asset is worth at this specific, current second. When that prevailing market value falls below your initial entry price, well, that gap right there is your unrealized loss. That gap is where all the friction exists. And spoiler alert, closing that gap is the primary goal of our intervention today. The absolutely critical takeaway from our source material is that in the spot market, unfavorable price movements require strategic risk management, not panic. When you see that gap between your entry price and the market value start to widen, your job is definitely not to just sit there, cross your fingers, and hope the market magically reverses. And it is certainly not to sell in a sheer panic, turning an unrealized loss into a completely realized one. No, your job is to actively intervene using calculated financial strategies. Which brings us to section 3, purchasing additional margin. Let's walk through the actual financial action here, step by step. Step 1, you identify the unfavorable price movement. Basically, the asset has dropped. Step 2, you purchase additional margin. And all that means is you buy more of that exact same digital asset at its new, lower prevailing market value. And step 3, by making that second purchase, you actively adjust the asset's overall cost basis. You are deliberately, strategically blending your original higher purchase price with your brand new lower purchase price. Now, you might be wondering, why on earth would I increase a position when it's already losing money? It feels entirely counterintuitive, doesn't it? But the text details 3 really strong primary reasons for utilizing this approach. First, to manage overall trading risk. By taking control of the math yourself, you aren't just sitting at the mercy of wild market swings. Second, to recover from unfavorable price movements way faster. And third, to adjust the baseline cost basis of the digital asset. You're literally actively rewriting the history of your trade to make it much more favorable to current conditions. All right, section 4, shifting your entry price. Now, what's really interesting about this is what the text reveals mathematically. It's fascinating. You have your initial purchase sitting up at a higher price. Then, boom, the market drops. So you issue an additional margin call, meaning you buy more at that new lower price. When you look at the combined position, your overall average entry price has actually shifted downward. You aren't stuck at that original high entry point anymore. You've essentially dragged your break-even point down to meet the market halfway. The source details exactly how this mechanism works. By increasing the position, your new average entry price aligns much more closely with the prevailing market value. Think of it like this. You've essentially abandoned your original entry price. It literally no longer dictates your success or failure. You now have this brand new average entry price that sits much closer to where the asset is actually trading today.
And this lowered average entry price completely changes the dynamic of the trade. It means the gap to market recovery has just been significantly shortened. If your entry price is lower, the asset doesn't need to climb nearly as high or pump nearly as hard for you to just break even or even step into an unrealized gain. You have actively manufactured a much shorter path to profitability just by understanding the basic mechanics of margin purchasing.
Let's move to and see how this builds into Section 5, Overall Portfolio Valuation. When you apply this margin purchasing strategy to an individual digital asset, you are actually directly influencing the health of your broader holdings. The source specifically clarifies how these tiny micro-level financial adjustments radiate outward. By actively managing the cost basis of just a single struggling asset, you're directly defending and actually improving the overall valuation of your entire crypto portfolio. It's a completely interconnected ecosystem. So, the crucial point we need to take away is this. Your portfolio's valuation isn't just something that passively happens to you. It is something you actively control through strategic adjustments. By deliberately shifting the cost basis through extra margin calls, you manage your trading risk, you drastically accelerate potential recovery, and you actually take the wheel when the market tries to push you off course.
So I want to leave you with this final provocative thought to chew on. Based on absolutely everything we've unpacked from the data today, if you can actively shift your average entry price and literally rewrite the math of your own trades, is an unrealized loss actually a trap? Or if you know exactly what you're doing, is it actually a strategic opportunity? Thank you so much for joining me for this explainer. Keep learning, keep analyzing the data, and I'll catch you next time.